Okay, let's unpack this. When you think about making money in the financial markets, what immediately comes to mind?
Hmm.
Is it complex algorithms, secret indicators, or maybe just, guessing which way the market will go?
Yeah, the usual suspects.
Well, our source material for this deep dive, it's pretty fascinating. It suggests that most of what we think is important
Uh-huh.
is actually missing the point entirely.
And what's really interesting here is that the author, Trader Tom, he makes this compelling case.
Hmm.
It doesn't really matter what you trade.
Right.
Currencies, stocks, commodities, options, whatever. This isn't a manual about, like, the specific tactics.
Mm.
It's really profoundly about who is doing the trading. His whole mission, it seems, is to help people think differently.
Ah, like his friend Mark Douglas said.
Exactly. Profitable traders think differently. That's the core idea he's building on.
And that's precisely what we're diving into today. It's essentially a psychology manual for traders. And it's penned by someone who's very open about his own struggles, his own imperfections, past and present.
Which makes it relatable, I think.
Totally.
Yeah.
So our mission for you listening is to extract the most important nuggets of knowledge from this source
Uh-huh.
to help you understand those unseen forces, the psychological ones, playing out in your own decision making.
Whether you're like a seasoned trader already.
Or just really curious about why people act the way they do in these high-stakes situations. So if you're trying to get consistent results in trading, what does Tom's perspective actually mean for you?
He's pretty direct.
He is.
He suggests that understanding the why, like the real source of a problem, is way more critical than the how of any specific technique.
Right. He writes that the lack of consistency, it isn't about the software you're using,
Hmm.
or subscribing to some guru newsletter,
Nope.
or even using the wrong technical indicator settings. It's none of that external stuff.
That immediately makes you wonder then, if it's not the tools or the market knowledge, what is the actual problem?
Hmm.
And Tom asserts it boils down to one thing. Just one.
Which is?
You.
Ah.
He doesn't pull any punches. He calls you the weak link in your trading equation.
Oh, okay.
But his point is, if you can grasp your own role in that equation, then you can start to tackle the real challenge.
Which is yourself.
Exactly. Mastering yourself.
He certainly isn't sugarcoating it. Calls his book sugar-free.
Yeah.
And he says he wishes he'd had a manual like this when he started out.
Says it would have saved him a lot of money.
And heartache, yeah. His core argument seems to be more analysis doesn't equal more profit. Simple as that.
And he contends that most trading books, especially the ones on technical analysis, they might offer good theoretical advice, sure, but they don't really have a meaningful impact on your actual trading results. And if you zoom out, this kind of thinking applies even at, higher levels. He points out how many professional hedge funds, they actually underperform the market year after year.
Really? So it's not just retail traders?
Apparently not. It suggests professionals often wrestle with the same psychological demons, just, with much bigger bankrolls.
Right.
So from his perspective, successful trading is actually a lot less complicated than it looks.
Simpler.
Much simpler than people think, because it's fundamentally not about super complex analysis or some secret software.
Okay, this is where it gets really interesting, I think.
Uh-huh.
Tom shares this conversation he had with a trader friend, and it just perfectly highlights this, core paradox of emotion in trading.
Okay, lay it on me.
Right, imagine this. You're trading, suddenly there's a news flash, you're caught on the wrong side. You lose, say, 5,000 pounds.
Ouch.
But then, later that afternoon, you manage to recover it all. End the day break even. What's your emotional intensity level? Maybe on a scale of 1 to 100.
Okay, recovered it though, so
Yeah.
maybe relieved, happy.
Okay, now scenario 2. You have a fantastic morning, you make 20,000 pounds. Nice. But then, you lose it all back in the afternoon. Same break-even result, 0 net profit or loss. But what's your emotional intensity there?
Oh man, that feels way worse. Making it and then losing it all, devastating.
Exactly. His friend rated scenario 1, losing then recovering, as a 60. Felt above average happy.
Okay.
But scenario 2, making 20K then losing it, that was a 90, felt much, much worse.
Even though the outcome was identical. Zero P&L.
Right. And this isn't just some anecdote. It perfectly illustrates Kahneman's prospect theory.
Ah, yes. Classic behavioral economics.
It shows how we make, frankly, irrational decisions when there's uncertainty involved.
And how the framing of the outcome, whether it feels like a gain or a loss, just completely changes how we perceive it.
Totally. It's like saying this drug will kill 10 out of 100 people. This drug will save 90 out of 100. Same facts, totally different emotional gut punch.
Right. And prospect theory essentially says we tend to avoid risk when things are framed positively, but we actually seek risk when things are framed negatively, trying to avoid that certain loss.
And here's the real kicker.
Yeah.
A loss feels way more significant than an equivalent gain.
Psychologically, yeah. Often cited as feeling about twice as powerful.
Which has huge implications for trading.
The big one being, we are simply not hardwired to trade well. Our natural psychology often pushes us in the wrong direction.
Yeah.
Tom uses this example, right? Where 95% of people chose a guaranteed 100-pound win over a gamble for 200 pounds.
Okay, risk averse with games.
But then, faced with a loss, that same 95% chose a gamble on a 200-pound loss over taking a certain 100-pound loss.
So risk-seeking with losses.
Exactly. Our instinct to avoid immediate pain, even if it means taking a bigger risk down the line, works directly against what you need for optimal trading. Tag the lure of the hit rate and the pain of loss aversion.
So, okay, given these psychological hurdles, where do traders often trip up day to day?
Well, one big one is the obsession with the hit rate.
Right, winning most of your trades. Sounds good, doesn't it?
It sounds good, but Tom argues it's actually one of the most misunderstood and detrimental ideas for a new trader. Because of loss aversion, that deep-seated thing where we strongly prefer avoiding losses over making gains.
Okay.
Our minds are just designed to move away from pain. So if your emotions are unchecked, they'll always steer you down the path of least immediate pain.
Which isn't always the most profitable path.
Rarely is in trading.
So what does this actually look like in practice?
Well, Tom shares this story about a client, John. Successful guy, real estate broker, great at reading charts.
Okay, sounds promising.
But he consistently lost more when he was wrong than he made when he was right.
Ah, the classic problem.
Yeah. His stats showed more losing trades than winners. And crucially, he held his losers way longer, averaged 32 minutes.
Compared to winners.
Winners he cut short after only 10 minutes. Why? He felt scared his profits would just vanish.
Fear taking over.
Totally. And then there's a really extreme example he gives, Kevin.
Kevin, what did he do?
Kevin boasted an incredible 95% win rate. 95%.
Wow, he must have been killing it.
Nope. Lost over 42,000 pounds.
How is that even possible with a 95% win rate?
He figured out this trick. He'd open opposite positions on two identical instruments, like hedging himself perfectly.
Okay.
Then he'd close the side that became profitable quickly, locking in a small win. That kept his win rate high.
But the losing side.
He'd keep the losing side open, just hoping it would turn around eventually.
Oh boy. How long did he hold losers?
On average, 3 to 4 days. That's over 89 hours.
While cutting winners in.
Under 2 hours.
Yikes.
Kevin's story is just a brutal illustration of the disposition effect.
Right, the bias where traders hate booking a loss.
Because it's painful, yeah. It confirms you were wrong.
Yeah.
But they're eager to book gains because it feels good.
That immediate reward.
Exactly. And as long as that loss isn't officially realized, there's always that glimmer of hope, right?
Yeah.
That it'll come back.
That's a really profound point he makes there.
Yeah, that for many traders, it's actually more emotionally painful to be in a winning position.
Because you fear losing it back.
Than being in a losing position where hope keeps you hanging on. It's completely counterintuitive.
Tom connects this to breaking addictions too, like smoking or drinking.
Mm-hmm.
He talks about his own success quitting, saying it only happened once he truly understood the nature of the trap.
The brain's mechanism for avoiding pain.
Exactly. Our brains tell us, don't use that stop loss to avoid the pain of taking the loss.
Or grab those profits quick to relieve the pain of uncertainty.
It's cognitive dissonance, right? That mental stress of holding conflicting ideas, wanting to make money, but also desperately wanting to avoid any discomfort.
So if our own minds are kind of rigged against us here, how do the consistently profitable traders manage it?
Good question. Tom sought answers. He talked to a friend he calls a greatest trader and also a great broker.
And what did they say? Any secret formulas?
Surprisingly, no. Their insights were almost entirely free of technical jargon or secret strategies. It was all about mindset.
Okay, tell me more. The greatest trader.
He explained his core principle basically like this. I have made a firm decision in my mind that I will not guess.
No guessing. Interesting.
Yeah. He doesn't try to pinpoint the exact top or bottom. He fully expects trading to be uncomfortable, even painful sometimes.
But he sticks to his rules.
Exactly. His strength, he said, is his curiosity to see how far a move can actually go and the aggression to stay in it.
Even if it means giving back some profit.
Even then, he only gets out if the reason he got in is no longer valid. Like, if he wouldn't enter the trade right now in that direction.
That's discipline. What about the great broker?
He pretty much reinforced the same idea. Said retail and institutional traders often have the same flaws.
Oh, real?
Yeah, the main difference. Pros usually have deeper pockets and, critically, external discipline from their firm, their bosses.
Accountability. Makes sense.
He also noted retail traders often lean too heavily on technical analysis. They're notoriously slow to switch direction when, say, big economic news hits.
Stubbornness.
Maybe. And they tend to trade the same position size, whether the market's dead calm or going crazy volatile.
That raises a good question for you, listening. Do you find yourself trying to buy weakness and short strength?
Yeah, the broker pointed that out. Retail traders hate buying strength, but they love trying to pick bottoms.
And they hate shorting weakness, but love trying to pick tops.
But the successful guys, they often do the exact opposite.
They'll short the DAX when it's already down 150 points.
Or buy the Dow when it's already up 100 points. Why? Because the market's strong or weak for a reason.
They get that the market often goes a lot further than anyone thinks. Trend following, essentially.
This perspective really challenges a lot of common ideas about technical analysis, doesn't it?
Hugely. Tom gives this great example with the doji candlestick.
Yeah, the classic reversal pattern.
Right. But he revealed that the guy who literally brought candlestick charting to the West,
Stevenson.
that's the one. He doesn't even trade them himself. Get out. That's what Tom says. And furthermore, rigorous statistical tests done by Victor Niederhofer on the S&P 500 showed that common candlestick patterns, including the doji, were not statistically significant predictors of reversals.
Wow. So much for that holy grail.
Yeah, it really highlights this validity bias we have.
Thinking we're more accurate than we are. Seeing patterns.
Exactly. Seeing patterns where none consistently exist. And technical analysis often doesn't answer key questions, like what time frame should you even use?
Right. What works on a quiet Monday won't work on a crazy Friday afternoon.
Precisely.
Yeah.
It's more about understanding what's actually driving the market at that moment. Is it oil prices? News out of China?
And having the flexibility, the courage to change your mind and adapt.
Instead of just rigidly sticking to some pattern you think you see on a chart. Hashtag tag the uncomfortable truth about stop losses and sustained success.
Okay, so if trading is a game of probabilities, like everyone says, and you are going to be wrong sometimes, that's just baked in, how do you manage that unavoidable reality?
This leads us straight to the absolutely critical role of stop losses.
The dreaded stop loss. Tom admits he used to hate them too.
Yeah, he was reluctant. Why? He says it was because he just didn't want to face being wrong.
Didn't want the proof.
And didn't want that immediate discomfort of seeing the money vanish from the account.
Relatable, I think. So why do you listen? Maybe avoid stops sometimes.
Tom suggests it's often because we put way too much importance, too much ego, onto a single trade outcome.
Yeah, makes sense. It feels personal.
It does. Admitting defeat is painful. But he shares some pretty stark market wisdom here.
Like what?
If you can't take a small loss, sooner or later, you will take the mother of all losses.
Oof, powerful.
And when asked about the key elements of good trading, his answer was simple. Cutting losses, cutting losses, cutting losses.
For repetition, for emphasis. It's that important.
Seems so. He tells another story, a dialogue with a trader who had this big aha moment.
What was it?
The trader realized, I'm trading my P&L, not the markets.
Trading the P&L, what does that mean exactly?
It meant they were making decisions based on their current profit or loss status, not on what the market was actually doing. Like taking quick wins right after a loss just to feel better, for mental equilibrium.
Okay.
Or risking more when they were already down, trying to get back to even faster, the gambler's fallacy.
And trading smaller when they were winning, trying to protect the profits they had.
All driven by the P&L, not the market setup. The core realization for this trader was profound. You have to become almost immune to the money.
Detach from the outcome.
Exactly. Focus entirely on executing your process, your plan, regardless of the last trade's result.
So what's the practical function of a stop loss then in this framework?
Well, putting aside the emotion, a properly placed stop loss answers one simple fundamental question.
Which is,
At what price is your initial trade idea clearly wrong?
okay, it's the invalidation point.
Precisely. And Tom recommends dynamic stops, not just fixed percentages. Things like stops based on average true range or APR
Why dynamic?
to account for the market's current volatility. A 20-pip stop might be fine on a quiet day, but suicidal on a volatile one. ATR adjusts for that.
Makes sense. Trading is probabilities.
You will be wrong. Even with the best analysis, the key isn't avoiding being wrong.
It's how you handle it when you are, how you manage the losses.
That's the aim.
Tom's final piece of advice here feels really personal, but also incredibly powerful.
Yeah.
He says, don't let one single trade become your entire identity. Don't let it become your ego or dictate your future fun in life.
Keep perspective.
Yeah. Maybe consider trading smaller. Place your trade, place your stop loss, and then, crucially,
Walk away.
walk away. Let it play out. It's just one trade out of potentially thousands.
Don't let it be your last one.
Exactly. Don't let it be the one that breaks you, financially or emotionally. Hashtag tag tag outro.
So we've really gone deep into the psychology of trading today.
We have challenged a lot of common assumptions, I think, uncovered some powerful, often subconscious forces at play inside ourselves.
Yeah, from John's struggle with cutting winners short.
To Kevin's crazy 95% win rate that still lost money.
And those surprising truths about technical analysis patterns and the absolute necessity of stop losses.
It really seems crystal clear that mastering yourself, your own mind, is the paramount task here.
Absolutely. The insights from this source material, they really show that the most critical things for consistent profit aren't the external tools, the indicators, the systems.
It's an internal shift.
It's an internal shift. Understanding your brain's natural biases, that aversion to pain, the seductive lure of hope.
And then consciously training yourself to act against those impulses sometimes.
To follow a disciplined process, yeah.
So wrapping up, what does this all mean for you listening? Maybe consider this final, quite provocative thought from Trader Tom. He says, win or lose, everybody gets what they want out of the market.
It's what they want. How so?
He continues, some people seem to like to lose, so they win by losing money.
Wow. That's blunt, but intriguing.
It is. So if his suggestion holds true, that you ultimately get what you truly want from the markets,
Whether that's profit or maybe just excitement or the feeling of being right for a moment.
then what hidden desires might your trading behavior, your patterns, be revealing about you?
Something to definitely mull over.
Yeah.
A powerful question to end on.